Hi students, good evening again. Today we are going to discuss some of the basic accounting concepts. There are some concepts, there are some conventions on which all the accounting building is built. So these concepts are the basis of the accounting when we are preparing the financial statement, or even when we are recording the basic financial transactions in the debit and the credit. So these are the basic, you can simply say, like a rules or assumptions, or we say the conventions or the concept which we have to follow. These concepts are used by the generally accepted accounting principles that are used normally in the American financial reporting or International Accounting Standard, or IFRS, International Accounting Standard Board is there. So they are also following these basic things. So they are mainly, some of the authors may have said they can have 5 different things are there, some have said 7, some 12, but we are considering all the 12 basic things which are used in the accounting for the different purposes. So we will discuss these one by one, because these are the things which are very important while recording the financial transaction, while preparing the financial statements, while applying the accounting rules. So these are the basic things on which all the financial accounting, even the accounting for the reporting purposes, so all the accounting is based on these things. So the first thing that we are going to discuss is the concept of the separate business entity. It is very simple rule, the very basic rule and very simple rule. Separate business entity means that the owner and the business, they are separate. So the business is a separate entity. You don't have to mix the things, because if there is anything which is related to business, it should be related to business only. If anything related to the businessman, so it should be recorded in the books of the businessman, not interchangeably. So the basic concept is that we have to prepare the financial statements. Nahin, cut. Okay. The first thing that we have is the concept of the business entity. Business entity means what? That is very simple concept. It means that the businessman is separate from the business. So when any person as an individual or in the partnership or in the form of the company or in the incorporation, when they start a business, they just some money. It may be $1, it may be millions of dollars. So with that, they can start a business as an individual or a partnership or the company or the incorporation. So when the owner is investing that money, it means he is investing that money for the business purpose. Now, anything which is recorded in the business should be considered as a separate from the businessman. And later on, if there is some payable, that is payable of the business. If there is anything receivable, that is receivable of the business. For example, if there is any problem like any court case is there or any other issues are there, so that is not against the owner, that is against the business. So we consider it that is the separate business entity, means it is a separate legal entity. It's an artificial person. Especially it applies to the companies or in corporations, that the business is considered as a separate legal entity. So it is an artificial person, obviously not a human person or not a human entity, but it is an artificial entity, because it can be sued or it can sue, means if they can go to the court in the name of the business, and someone can also go to the court against the business. So the very basic thing, that the businessman is separate and the business is separate, and business has its own legal entity where we have all the contractual rights. They can make a contract, they can make an agreement. So the business can also make the agreement, the business can also have any type of the breach of the contract. So all the legal aspects will be same as a person which is a natural person. So it is separate legal entity. So the second thing that we have is the concept of the duality. Duality means that we have every transaction has a debit and the credit. means every transaction has a two effects, and those are the at least two effects. I hope you remember the very basic accounting concept, the concept of the capital plus liability is equal to asset. So this is the basic accounting equation, and we already discussed in detail that the both sides should be equal. And if there are at least two effects, then it means the equation will be same. For example, 2 plus 2 is equal to 4. Then if we want to write here 5, it means either we have to minus from here or we have to plus on the other side. So at least two effects are there, and these two effects are recorded in the business while recording the transaction in the form of the debit and credit. So every transaction, anything which is happening to the business which has some financial value, so it should be recorded, but it should be recorded in the form of the debit and credit. So dual aspect is there. So duality means two effects. So at least every transaction has two effects. So that is concept of the duality. Now the third thing which is very important, that is the concept of the monetary measurement. Okay. Monetary measurements means what? That if you can measure the value of that transaction in the money may be a dollar, it may be a pound, it may be any other yen, or it may be any other rupees. Okay, so if you can measure it, for example, this marker has a value. For example, if it has a value of $1, so it means it has a monetary value. So it means anything which is happening in the business, if it has some monetary value, means it has some value in the currency, then it will be measured. Measured means it will be written in the accounting records. And how it will be written? It will be written in the form of the dual concept, so debit and credit. So any transaction which has a monetary value, which has a financial effect, even if it is a $1, if it is $1 million effect, but still it should be measured in the value. So the emotions cannot be measured. So you are going to get the loss. So we cannot say that the loss is for $10 and there is a emotional breakage of the $100. So we cannot write that one. So we have to write only $10, which is the loss of the business. So this is the next concept, that we have to write everything in the money. Otherwise, if it cannot be measured, so we cannot write in the accounting. The next thing is the concept of the matching. Matching is basically related to the income and the expenses. For example, if we are here in 2023, so the expenses and the revenue, we have to write all the expenses after 2023 and all the revenues of 2023, because we want to match, we want to know the profit or loss of that specific year, that specific financial period. So we cannot write the expenses of 2022 and the revenue of 2023, or we cannot write the revenue of the 2022 and the expenses of 23 and then we can match. While matching the revenues with the expenses, the financial year will be same. If the year is not same, it means we are not preparing the financial statement, we are not doing the accounting as per the basic rules. So if there is anything loss or expense of the current year, so it should be matched with the loss or expense or the revenues with the current year. So the revenues of the current year should be matched with the expenses or the losses of the current year. If there is any income of this year, should be recorded this year. If there is a loss in this year, it should be recorded in this year, and then it should be matched. So we don't have to match the previous year's transaction or the next year's transaction. So transactions means the income transactions or the revenue transactions and the expenses or the losses transactions should be for the same year. So we have to match from the same year. So that is very important thing, and it should be at the equal level, means 2023. So all transactions, all expenses, all revenues should be matched. Otherwise, it will not be a real concept. The next thing, that is the concept of the cost. So whenever you are buying any asset, I hope you remember the concept of the assets. So anything which has a value, which is used or controlled by the business and which can be converted into the cash now or in the future. So that is considered as the asset. Asset, we have current asset or the non-current asset or fixed asset. So the cost concept, especially for the assets, whenever you are buying something, you have to write it cost. Cost means you should not write that what is the value in the mind of the person, or what is the value in the mind of the seller or in the mind of the buyer. So we have to consider that how much the business has paid for this asset, so that cost should be recorded in the business. For example, we have purchased some car and that is for, let's say, $5,000. So you cannot write 4,999 or you cannot write $5,001. So you have to write exactly the same amount, the cost of that asset. So it is very important. So we can add, for example, if there's any transportation cost is there, we can add if there's any government taxes are there, or if there's any registration fee, or you are paying any agent fee, or like insurance or any other thing. So it can be added. So these are the part of the asset. So the cost of the asset should be recorded, how much you have paid or the business has paid for that asset. Then the next thing is related to the accounting period. Accounting period means when you are preparing the financial statement, when you are preparing the profit or loss or the income statement or the statement of financial position, means any report when you are preparing, you have to follow the accounting period. And the maximum accounting period is what that is allowed, that is 12 months, but that is maximum. Means you can prepare your financial statement even after 1 day, after 1 month, after 3 months, after 6 months, after 1 year, but not more than that. So accounting period is normally the 12-month period where you are preparing the financial statement, and normally as per the accounting standards, even as per the government rules or Securities and Exchange Commission rules, they have to prepare the financial statement for that specific period, and that period is called the accounting period. Normally that period is 12 months, but it cannot be more than 12 months. It can be 6 months, the internal financial statements are prepared. It can be 3 months, even the monthly statements can be prepared, or even the daily statements can be prepared. But maximum time period, or the general, you can say the time period which is followed by the companies or the businesses, that is 12 months. So accounting period is the 12-month period. So when you are starting a business, so you have to follow some specific accounting period. It may be ending on the 31st December, it may be ending on the 30th of June or the 30th of the September. So it depends on the type of the business and which rules they are following, but they have to follow the accounting period. Number 7 concept is the concept of the conservatism. Okay, conservatism is a very basic concept in the accounting, that if there is any expected loss in the business, you have to consider it. But if there is any expected profit or any expected income in the business, you should not consider it, you should not write it. A very simple example, for example, we have, let's say, that the business expect that in the next financial year they may have a $200 loss in the form of the bad debts. So what they do, they just create a provision for that this much amount they will not be able to recover from the debtors or from the customer. So it is not a real bad debt, it is expected bad debt, but the accounting rules as per the conservative convention, it is allowed that if there is any expected loss in the business, you can write it, you can record it in the financial statement. But if there is any expected income, means, for example, you think that in the next year you will get revenue, extra revenue of 10%, 20%. So now you cannot write it in this year. But if there's any expected loss, any provision you can create, any allowance you can create for the next expected losses. So this is the concept of the conservatism. The next thing is what, number 8, that is the concept of the consistency. There are accounting rules, some of the basic things. For example, we have a very basic thing like a depreciation. In the depreciation, let's say we have two methods like straight line method is there, and also the companies can follow the sum of years digit method or declining balance method. No, if the company is using the straight line method, they have to use the rule consistently. Means they cannot change the rule. Obviously there are exceptions are there, they can change the rules of the depreciation, they can change from the straight line method to the declining balance method or double declining balance method, but obviously there are some processes are there which they have to follow. But normally the accounting rules which they are following, they should follow it for the years. Means they have to follow it consistently. They cannot change the rules every year, because if they're changing the rule this year, for example, if they're using the first in first out method and they're switching it to the weighted average method, so what will happen, the previous year's values will be different, so they have to disclose it. So that's why it is recommended that if you are following some accounting principle, when you have a different choices, you have to follow that principle consistently. For example, depreciation method is there, or direct write-off, or the allowance method is there for the bad debts, or there's a possibility of the inventory valuation method. So any method which you are following, it should be followed consistently. It should not be changed immediately and from year to year. Every year you are changing, it is not a good sign for the business. The next thing, that is the concept of materiality. And that materiality concept is what that is related to the stakeholders or the business users. Who are the stakeholders or the business financial statement business users? Means any person who is making the decision on the basis of the financial report. So they have to consider the materiality. Especially it is mainly related to the concept of the audit, that they have to consider the concept of the materiality, that anything which has a major effect on the business, and that effect can change the decision of the person who is using that financial statement, so it means that is material. So if there's any change, so it can, if there's any error, if there's any mistake, if that mistake or if there's that error can change the decision of the person, okay, so that will be considered as the material. So anything which is important for the business, which is a huge effect on the business, like if there's a, for example, business has a total sales of 1 million, but there's a mistake, there's an error of $1 or $2, obviously that amount is not material. But out of $1 million sales, if there's a mistake or there's a misstatement of, let's say, 500,000, obviously that is material. So the materiality means that anything which is important for the business, which has a significant effect on the business and especially on the decision making of the businessman or any other person who is using that financial statement, so that thing will be considered as material. The next thing we are discussing is the concept of the going concern. The going concern means what? That this business will continue for at least one more year. Why this concept is needed? Why this is important? Because if the business is applying for the loan to the bank for, let's say, for 5 years, the loan is approved for the 5 years, and the bank is not sure that this business will continue for the next 5 years, they will not approve the loan. So the bank should be sure about that thing, that the business will continue for at least next 5 years to give back the loan. So for example, if there is a supplier, they are supplying the goods to the business and they are on the credit basis, or they are making a contract on the long-term basis, so they should be sure that the business will continue. For example, if the customer is there and the business is giving them the guarantee or warranty, but customer is not sure that the business will continue for the next 1 year, 2 year, 5 year or not, so obviously they will not make any agreement, they will not make any contractual thing with the business. So that's a very important thing, that business is a going concern. When the businessman, when the owner or the people who are just collecting their money to start the business, when they start it, what they do, in their mind it is considered that this business will continue forever for the indefinite period. Okay, especially when there's a companies are there, you have many examples, those companies or even some banks are there, they are working even for more than 100 years or for 200 years, Some businesses are there, they may be a small business, a local business, or international businesses. They have a life of even more than 100 or 200 years. It means this going concern is the concept that business will continue, especially when we are thinking about the audit concepts. When we are thinking about the auditors, it is very important for them, and especially it is the a part of their, you can say, the audit report that they have to give like a assurance to the shareholders that this business will at least run for one more year. So that's why the going concern is very important. Going concern is simply mean that this business will continue for at least 1 year, but obviously for the future, for the indefinite period. The next two concepts are basically the interrelated concepts are there. Accrual concept and the realization concept, number 11 and number 12. So we will discuss these concepts in detail, and with a small example also it will be very easy to understand the concept.